Aside from the actual definition of contagion, is the rout going to stem, or is there more to come?
We think there's some value there, especially if you look at the larger countries like China, like Taiwan, like South Korea. We think there's some real value there. They're very much reorienting themselves towards technology, towards, kind of fueling that consumption that China's been talking about for some time now. It really is the weakest links, which are kind of, working their way up in terms of, falling. But we do think it stops probably here. Those countries really have issues that are idiosyncratic.
Well, it isn't entirely idiosyncratic. How much of it was because, frankly, of Fed policy, because they're taking liquidity out of the system, which strengthens the dollar, and also we have President Trump, even today, the possibility of another $200 billion worth of imports from China having tariffs imposed.
Yeah, so sentiment's a big deal, right? So, if you look back in January, emerging markets were basically trading at almost 17 times, right? It was a new dawn for emerging markets, right? It was kind of the new thing, right? They were now technology heavy, and they weren't going to be commodity producers anymore, and we were going to pay, almost a multiple that was like double what history would suggest. And now they're much more reasonable on a valuation standpoint. So what we would say is emerging markets are still emerging, but the valuations are a lot more compelling now.
So you're definitely not alone in that. If you come inside the Bloomberg here, you can see kind of what we're talking about. So the white line is emerging market bond ETF. So obviously if it goes lower, it means the yields are going higher, around 6%, right? Then the blue line is the bond shares outstanding for the ETF that tracks emerging market bonds. So 6% seems to be a level that's going to be drawing in investors. How do you distinguish, though, how do you distinguish from the value versus the value trap?
No, that's a great question, and that really is a $64,000 question. And this is where we would say, we've enjoyed passive investing for the last 9 years now, and this really is the time where active will start to outperform passive. So what you really want to do is shy away from broad emerging markets exposure within ETFs, and really kind of figure out which managers are doing the due diligence and trying to figure out where the values are and where the value traps are.
To what extent is the United States causing the problem for the emerging markets? Particularly, the U.S. is doing so terribly well. We'll put a chart up here, actually, that shows the run-up in the S&P, for example. It's the biggest, longest highest since back in the late 90s as we went into the tech bubble, frankly. Is that really driving the EM down, in a sense?
It is, because again, when the U.S. is outperforming, the dollar tends to attract a lot of inflows. And when the dollar attracts inflows, clearly they've got to come from somewhere, right? It's a closed system, it's a zero-sum game. And right now they're coming out of emerging markets, and so that's just putting further pressure on those currencies. And if you happen to have borrowed in dollars, well, now you have to pay higher yields, higher spreads, and pay back in a currency that's appreciated.
The question also becomes, is if we see inflation move anywhere in the U.S., though, that could be a negative. Citi had a note out yesterday just talking about that look, you could take some risk off into the jobs number tomorrow, because if you get any wage gains, you're back to a February environment where you're going to see a sell-off because of worries about tighter Fed policy. What's the feedback loop for you there?
So we would agree with that. Now's a great time. There's a lot of complacency. September is historically a very weak month. You still have midterms going on. You've got a lot of different things where, sitting here close to 2,900, we would say we're at our year-end target, actually at the upper end of the year-end target. It is a great time to rebalance.
Where?
So what we would do is we would actually tilt back a little bit towards emerging markets and towards developed markets. We think the dollar's probably running a little too far, and we think, if you look at kind of the relative surprises, they'll probably over the next 12 months surprise more on the international side than the U.S. side.